Welcome to Alexander Forbes Investment Weekly Economic Focus with me, Isaiah Mhlanga, the Executive Chief Economist. October brought a cocktail of bad economic data, downwardly revised global growth expectations, and continued capital flight from emerging markets, which culminated in increased volatility and negative returns in all major asset classes. Oil prices initially increased above $80 per barrel before declining by 14.2% to $73 per barrel in October. However, on a year-to-date basis, prices remain 8.7% higher. The MSCI World Indices retained negative 7.3% in October in US dollar terms. The MSCI emerging market equities are down 8.7% in October and 15.5% year-to-date. Bond markets also saw negative returns, with the Citi World Government Bond Index returning negative 1.1% on the month and negative 3.6% year-to-date. The JP Morgan Emerging Market Bond Index returned negative 1.2% in October and negative 10.4% year-to-date. October's market performance highlights a slightly worse outlook than what we have been emphasizing over the past couple of months, that we are in a lower return environment. It has become more likely that we will see negative returns for 2018 as a whole, if we do not see a rebound in markets as we move into year-end. That said, even if we see a rebound, it is likely going to be a temporary rebound given that risks are increasing. Interest rates are on the rise, ongoing trade tensions, and the beginning of Iran sanctions on oil exports, and the overall impact these will have on global economic growth. In the US, technology stocks have carried US equities higher in 2018. At some point, there was even debates on whether they could be safe haven assets, but October showed that they are not, as the decline following the below expectations earnings, which resulted in a sell-off in overall equity markets. With a decline of 6.9% and 9.2%, October 2018 is the worst for the S&P 500 and the Nasdaq since 2008. Due to capital flight from emerging markets into safe haven assets, the US 10-year and 2-year bond yields were up 6 basis points and 5 basis points to 3.17% and 3.09%, which leaves the yield curve a mere 8 basis points from inversion. The US dollar index was up 0.6% in October and 4.3% year-to-date. European markets followed the US markets lower on the month, although they were up last week. However, they were all up by at least 3.3% last week. Bond market performance varied by country and duration. 2-year bond yields declined in Germany, Italy, and the UK over the month, but they rose last week in Germany and the UK due to Brexit concerns. The MSCI Emerging Market Index recouped lost ground last week relative to the previous week, rising 3.4%, however, 16% lower on a year-to-date. For the month, the Brazilian MSCI was up 15% following the election of a far-right Jair Bolsonaro as president with 55% majority vote. Elsewhere in emerging markets, equities were down across the board due to capital flight to safe haven assets. This week will be a big week in markets. First, US sanctions on Iran's oil exports kicks in on Monday, the 5th of November. Iran's oil production is already declined by some 10%, but so far this has been offset by increased production from other OPEC producers. Market expectations are that oil prices will likely rise once sanctions take effect. Second, the US Fed is expected to hike rates by 25 basis points when they meet, taking the likelihood of a US yield curve inversion even closer. An inversion of the US yield curve has preceded 7 out of 7 past US recessions 4 to 5 quarters later. More importantly, the US midterm elections are likely to have significant impact on markets depending on whether there are changes in who leads the House and the Senate, which are both currently led by the Republican Party. Here at home, money supply beat expectations, growing by 7% year-on-year in September. However, private sector credit extension moderated to 6.2%, which was also below expectations. The trade balance turned into deficit of $3 billion from a surplus of $8.8 billion in the previous month. The APSA PMI index, a gauge of the health of the manufacturing sector, declined to 42 points from 44, which implies that just under 60% of manufacturing purchasing managers are dissatisfied with prevailing business conditions. This doesn't bode well for this week's manufacturing and mining production data. Perhaps the more concerning data was the unemployment rate, which increased to 27.5% in third quarter from 27.2% previously, which is in line with an economy in a technical recession. Not all is bad and gloom. A coordinated communication strategy seems to be on the cards from the South African Reserve Bank and National Treasury, with the governor highlighting that the policy debate is being won by the orthodox and the rational side, while the finance minister categorically said South African Airways needs to be closed because it's a loss-making institution. With this said, local asset class returns were in the red except the tradable property index and cash, which returned positive 0.1% and 0.6% in October in rand terms. The JSE All Share returned negative 5.8%, while the top 40 index returned negative 6.7%. Industrials were the biggest loser with negative 8%, followed by resources and financials with negative 4% and negative 3.2% respectively. This October recorded the second worst returns in 23 years. The stage looks set for a relief rally in local equities. Outflows have been significant, technicals are supportive, valuations are cheap, and the policy measures in China indirectly support South Africa via the resources sector and China-exposed stocks. Indeed, the 10 largest active fund managers locally have reduced their global holdings by 3.9% and rotating into local equities, cash, and bonds. That said, 2019 still looks to be a challenge for South African assets as global growth slows and monetary policy tightens. That was the week and month that was, and the week ahead from me, Isaiah Mhlanga, the Chief Economist here at Alexander Forbes Investments. Look out for future updates, keeping you informed in this slow return environment. Remember, investment gets rewarded over the long term and not over the short term. Goodbye.